Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. Today we're taking a look at three highly ranked large cap stocks to consider buying before their upcoming earnings reports for big long-term upside. The three stocks we're looking at are Honeywell, DexCom, and NextEra Energy. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into these three stocks, I quickly just want to do a broader overview of the market as we hit into the really heart of earnings season. So we saw the NASDAQ fall about 2.1% on Thursday, with the S&P 500 down about 0.7%, as Wall Street decided to utilize Tesla and Netflix's earnings releases as a chance to start locking in some profits. So Tesla was down about 10% on Thursday, and Netflix was down about 8%. As we also saw some selling across semiconductors and some other big players in Wall Street, including Apple and Microsoft. As of this recording on Friday mid-morning, the market was kind of mixed. The NASDAQ was actually like flat as I'm recording this. So more subdued day on Friday ahead of a big week next week. So given the huge run, it could be that many of these big tech stocks that have gone up so far will have to really outperform estimates and offer impressive guidance to avoid some near-term profit taking, though. That said, a near-term pullback over the next several days or several weeks might prove healthy in the long run, as a cool down could appear pretty useful at the moment. That said, we do have a long way to go before we get back to those fresh all-time highs, even though many of these big tech names are at new highs. The NASDAQ still down about 11% from its highs, with the S&P 500 down around 7% from its highs. That said, though, inflation in the Fed and the overall earnings picture remain pretty bullish. In the most recent Zacks data, which highlights kind of an improving earnings picture that we've been seeing for Q2. So I quickly wanted to just highlight some of the stuff that is from our most recent write-up from our director of research, Shraz Mian's big earnings previews and earnings recaps. So he said, quote, "We're off to a positive start to the Q2 earnings season, with most companies not only beating estimates, but also providing reassuring enough guidance for the coming period. So that's a great start." And then he said, overall, given the below average magnitude of negative revisions to Q2 estimates ahead of the start of the reporting cycle, this above average EPS beat percentage can be interpreted as a favorable turn in the underlying earnings trend. So he's seeing upbeat turn to the Q2 outlook as well as Q3 and going forward. So at the moment, Q2 is expected to mark the bottom. We're calling for about 9.3% earnings decline, and then we're climbing back up to just a decline of 1.9% in Q3 and then back to growth in Q4. And then overall in the annual picture, we're calling for about 4.1% earnings decline on about 0.2% higher revenue, and then storming back to 11.2% growth in 2024 on about 5% higher revenue, with then another 11% earnings growth in 2025 projected. So if these estimates can hold up through Q2, you could see Wall Street finally breathe that big sigh of relief that earnings are trending back in the right direction and that they have bottomed already. And that way the market won't have to recalibrate too much more. So with this in mind, we're going to take a look at three highly ranked Zacks stocks that might be sitting at levels that will look possibly like steals are really attractive in the next 6 months and certainly probably 6 years from now, that are also set to report their earnings results next week. So the first one of these three stocks is Honeywell, which trades in the ticker HON. It's set to report its Q2 results on Thursday, July 27th. Honeywell is an industrial products company that's transforming into a hybrid version for the modern world. It's aiming to become, and kind of already is, a digital software industrial company. That's kind of what they refer to themselves as. So Honeywell's portfolio spans across aerospace and travel, technology, energy, healthcare, utilities, logistics, and beyond. So for instance, their air turbine starters help drive a large chunk of commercial and military aircraft. Its solutions are really endless, so I don't want to just dig in deeper and deeper to everything they have, but Honeywell has technology that's on NASA missions, as well as high-tech temperature controllers that you might find in your own home or your office building. They break down their business into aerospace, building technologies, performance materials and technologies, and safety and productivity solutions. So those are their big sectors. The company posted about 3% growth in 2022 and about 5.5% growth in 2021. and we're calling for another 4% revenue growth this year, and then another 5% revenue growth in 2024. And then on the bottom line, we're calling for about 5% adjusted earnings growth in 2023, and then a 10% jump in 2024. So some nice, steady positivity from a big company that's set to do about $37 billion in revenue this year. So huge top line and bottom line. And then overall, its earnings revisions are trending in the right direction to help it land a Zacks rank number 2 buy at the moment. And it's topped our estimates by an average of 4% in the trailing 4 quarters with a 7% beat last quarter. So that's a really positive sign. And then overall, Wall Street's pretty high in the stock. So of the 15 brokerage recommendations that Zacks has, 9 are sitting at strong buys, with only 1 sitting at a strong sell. So overall, Wall Street's still really high in the stock. And over the last 20 years, Honeywell shares are up about 640% versus the S&P 500. It's 360%. So really strong outperformance there. That said, it has underperformed the market over the last 5 years, up just about 36% versus 63%, with it down about 11% from its highs in August of 2021. So that's a good sign for people who are trying to get into Honeywell stock. And it's still down slightly in 2023, so it has not got caught up in this wave of positivity. And we do see that a new CEO stepped in on June 1st. It was announced a while back. So it's a good sign they're seeing a transition period, and Wall Street will probably start to react to that positively sooner than later, especially for a company that has such a big business that's steadily growing. It's also still one of the 50 largest companies in the S&P 500 with a market cap of nearly 140 billion. So it's a massive company with a long-term outperformance of the market over the last 20 years that's kind of fallen on a bit of a downturn in the last several years, so certainly worth considering at the moment. Its dividend yields 2% at the moment, and it's trading above both its 50-day and 200-day moving averages, and it recently found support at its 21-day moving average, so that's a positive sign heading into that earnings release. And it's trading at a 24% discount to its highs at about 21.6 times forward 12-month earnings, and right near its Zacks Econ sector, even though it's crushed that sector over the last 5 years, up 36% versus 10% for the sector it's in. And it's also trading right near its own 5-year median. So its valuation's looking strong as well. So Honeywell certainly worth considering heading into that earnings release. Maybe some people want to wait until after the report, since things can trade somewhat wildly right in the days after the report. But overall, certainly worth considering Honeywell as a buy long term and putting on your watch list at least. The next stock we're looking at is DexCom, which trades on the ticker DXCM. And it's set to report also its Q2 results on Thursday, July 27th. So the company makes continuous glucose monitoring systems designed for people with diabetes. The firm allows people with diabetes the chance to place small sensors just beneath their skin, most often on their abdomens, though they can be at other places, and then continuously monitor their glucose levels. Dexcom's readings and data then come through on the company's devices or via an app on compatible smartphones or smartwatches and other devices. The systems have become really widely popular because they don't require people to prick themselves throughout the day in order to measure their glucose levels. And their internet-connected data-sharing devices are also helpful because they enable family members and friends and healthcare providers to receive that data remotely in order to help make sure the actual users have the proper medical decisions made for them if they need to be monitored like that. The company's continuous glucose monitoring systems are also part of that connected health revolution that's still in the somewhat early stages, and it's poised to kind of become the standard form of medical care and treatment in the coming decades. And its systems are more beneficial for patients, caregivers, compared to more traditional old school blood glucose meter, because you can check those levels at every single moment. So you don't just have to have people decide to do it at certain points of the day. In the addressable market, is growing. It's the simple fact that diabetes has become more common in the U.S. About 1 in 10 people in the U.S. have diabetes, and 1 in 3 have pre-diabetes, according to the CDC. Worse still, diabetes is the 8th leading cause of death in the United States. Rising rates of diabetes, mostly type 2, is not just a U.S. problem, with roughly 1 in 10 people around the world living with diabetes. And the International Diabetes Federation predicts that the number could climb to about 645 million by 2030 and nearly 800 million by 2045, up from about 540 million at the moment. So trending in the wrong direction in terms of people's health, but if you're an investor, you can't really necessarily think about it that way, and DexCom is providing a service that these people will most likely need. Overall, the revenue's been pretty steady, so they did about 25% revenue growth in 2017, 44% revenue growth in 2018, 43% in 2019, 31% in 2020, 27% in 2021, and then 19% growth in 2022. We're calling for another 20% growth this year in 2023 to get up to about 3.5 billion, up from about 2.9 billion, and then another 20% in 2024 to get all the way up to 4.2 billion. So just the steady churn of growth for this company. And then on the bottom line, we're calling for about 23% adjusted earnings growth this year, and then another 40% adjusted earnings growth next year. And its upward earnings revisions help it land a Zacks rank number 2 buy heading into its release as well. And Wall Street's pretty high on the stock. 13 of the 15 brokerage recommendations that we have are sitting at strong buys with only 2 holds. Overall, the stock has been on a tear over the last decade. It's up 2,200% over the last 10 years versus the Nasdaq's roughly 290% climb. Over the last 3 years, though, it has cooled down a bit. It's up just about 23% compared to the Nasdaq's roughly 32% climb over the last 3 years. So a bit of a cool down, and it's still trading roughly 20% below its peaks. That said, it has come back in a big way over the last year. It's up 50% over the last year and 16% so far in 2023. So it's not been one of the stocks that's really ripped higher in 2023. And it's still trading, as I said, 20% below its highs. So in terms of valuation, it's trading at pretty sky-high forward earnings multiples. But if you factor in growth, its earnings growth outlook, which is that PEG ratio, it's trading at about 2.5, which is 25% below its own 5-year median, which is a very solid figure at the moment. So you're getting trending in the right direction in terms of that, just that continued growth on the bottom line is why Wall Street's been willing to pay up for this company. And for all the factors I talked about with just the growth of the connected health universe, their sales growth, and then the wider addressable market for diabetes, which is just getting worse and worse in the U.S. and around the world. It's worth considering DexCom at the moment. And then the last stock we're going to talk about today is NextEra Energy, which trades on the ticker NEE, N-E-E. It's set to release its Q2 earnings results on Tuesday, July 25th. So NextEra operates one of the largest electric utilities in the U.S., which is Florida Power and Light, which services over 12 million people. And it's also one of the biggest producers of wind and solar energy on the planet. And it's battery storage leader as well. And it has exposure to the potential long-term upside of nuclear power, which is coming back, not only in the U.S., but in other parts of the world as everyone tries to get slowly away from more fossil fuels. So nuclear is going to play a role. The company also combines, just the potential growth of renewable energy with this stability, of an electric utility. It boasts a huge market cap, and it's the largest holding in the utility sector Spider ETF. So that's that XLU. So that just shows its size and strength. It's expanded its contracted renewables backlog in the first quarter to about 20.4 gigawatts. It reaffirmed its 2023 earnings guidance and its long-term financial outlook, which is impressive, as it includes a strong bottom line expansion and dividend growth. And then in terms of dividend, its yield is about 2.5% at the moment, and it's raised its payout by an average of 11% annually over the past 5 years. In terms of growth outlook, it's pretty impressive. So we're calling for 30% revenue growth in 2023 to get up to 27 billion, and then post another 8% growth next year, with the bottom line set to grow about 7% this year and then 9% next year. Its earnings outlook's continuing to improve, with 2024 trending steadily in the right direction. This helps it land a Zacks rank number 2 buy at the moment, and 10 of the 13 brokerage recommendations that Zacks has are strong buys with no sell. So Wall Street's really high on NextEra. And in terms of its price performance, the stock has climbed by about 260% in the past decade and nearly 900% in the last 20 years, with a total return of nearly 1,700% over the last 20 years. And this is versus the S&P 500's 360% run over the last 20 years with a total return of 620%. So just huge outperformance over the long haul. This outperformance includes 3 years of sluggishness, highlighted by some pretty big up and down moves. And NextEra is currently trading around where it was in September of 2020, in over 20% below its all-time highs. The downturn has NextEra trading about 33% beneath its highs in terms of valuation. It's trading at 22.8 times forward 12-month earnings at the moment, and not too far above its decade-long median. So valuation looking worthwhile. It popped on Friday morning the last time I looked. It's now back above its 21-day and 50-day moving averages, and it's now going to need to retake that 200-day. And it is worth noting, longer-term trend watchers, that it's now back above that 200-week moving average, which it had slipped below. So that was not a good sign. But now that it's back above that moving average and it's more short-term moving averages, it could possibly be ready to finally break out after this period of sluggishness. Maybe some people want to hold off to see how it reports next week. But NextEra is certainly another name worth considering at the moment. And as a full disclosure, I own NextEra personally and in the Zacks Alternative Energy Innovator service. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.